Welcome to the Titans of Industry show. I'm glad you're taking time to learn about finance, economics, and some of the opportunities and threats which our portfolio faces right now. In the last few weeks, you've seen Wealth Research Group create the following themes and segmentations with our interviews: precious metals, cryptocurrencies, commodities, company leaders making interviews on the progress of their own firms, and big picture interviews. In the month of April and now halfway through May, we've had a number of important and fun interviews to go back, relax, and listen to. We first had, and I'd suggest you take a look at it. It's a micro documentary that we published about, it's titled Apple and Tesla's Worst Nightmare, Child Slavery 2017, which deals with the Congo's cobalt industry. We had Gary Christensen, who similarly to our great guest today, has done extensive chart plotting on the gold sector and calls for gold 10,000. And we had Jordan Royburn, a good friend of ours, who was just on discussing short-term technical analysis. It's a must-listen for investors owning the mining shares. And Amanda Johnson of Dash.org, the emerging cryptocurrency. Today, I welcome a first-time guest to the show, Mr. Daniel Ammerman, an absolute retirement guru, and with about a quarter of Americans hitting 65 years of age, with insufficient savings and little to no financial assets, cash-producing assets to bank on during retirement. The reliance on Uncle Sam is ridiculously high right now. If you're a millennial tuning in, this interview will be vital, as you must learn the demographics of the precious, it's the demographics of the previous generation. And if you're approaching retirement, Daniel will raise many serious threats and hopefully solutions to some of the challenges ahead. Daniel, how's life? How are you?
It's good. Thanks for having me, Lior.
I'm glad you're with us. Look, I want to get started. I want to get started with some of these incredible slides that you sent over, and they're on screen right now. People listening and taking notes here will be shocked by the type of political decisions which must be made in the coming years if the U.S. has a chance to sustain its credit score and the confidence that the currency has by these unfunded liabilities. What we're looking at on screen is the next 14 years is a surge in benefit cost. And Daniel, can you explain the factors driving this surge? What states are demographically more popular with the retirees, and what type of proposed solutions are politicians coming up with to deal with this surge?
Well, that is a pretty shocking graph. I think maybe an even better one to take a look at is if we look at the yellow circle on the black background that has the three different arrows, where we have our future national debt, our future Social Security and Medicare, and our future interest rates, or what we're going to earn in our retirement accounts. And unfortunately, the norm is to treat those as being three separate subjects, but they're not. You can't have any idea of how much Social Security and Medicare payments you're going to get without including the national debt. You don't know what interest payments you can get without looking at the national debt, because the U.S. government has to make interest payments on the national debt. And as I have analyzed and written about extensively before, the main reason we have the lowest interest rates in recorded history are because we have a close to $20 trillion national debt at this time. And the other issue to keep in mind as well, and that's part of what we're going to go over, is that there is a very real cost to national debt. Some people think the national debt is just something kind of abstract, or maybe someday we'll default on it, or maybe some way we'll have to inflate our way out of it, or something like that. But the fact of the matter is that the national debt is changing all of our standards of living today, and is likely to be an even bigger factor in the years to come, particularly for those who are relying upon Social Security and Medicare payments, but also people who are looking at interest rates. So what I took a look at in this first graph, which is titled The Coming Surge in Benefit Costs. And in this particular case, I just derived it from the Congressional Budget Office projections, the CBO projections, is the increase in benefits that the government itself is estimating that we're going to have to come up with in each year to come. Because we're at this crucial point here. The absolute peak years for the baby boom are between the years 2027 and 2029, assuming a normal lifespan, of those have been extending somewhat. We're still really just getting started when it comes to large numbers of baby boomers retiring each year and having a great deal retired together. Then the other fundamental issue that we run into that may sound a little obscure now, but it's going to change all of our decisions and change all of our standards of living, I would argue, is that the baby boomers are starting to get older. Medicare is not evenly distributed. Disproportionately, the highest cost to the country, to taxpayers, to the government of Medicare recipients is in their last year or two of life. And that can maybe sound a little bit morbid, but financially, that's what really matters. So it's not so much baby boomers hitting 65 that drive the very high expenses of meeting government promises and just providing basic medical care. It's baby boomers reaching their final year or two of life, which can happen at almost any time, but is going to be peaking.
Daniel, in those 1 to 2 last years, I mean, what are the extra costs?
If we look at the projection, by the end of this fiscal year, it should be up by about $83 billion. And it starts to rise very rapidly. It's up to almost $500 billion a year above where we are today. That's doubling the deficit by the year 2020. We're up to $1 trillion a year by the time we're out to about 2023, 2024. $1.5 trillion a year in less than 10 years, in about 2026. And over $2 trillion a year over and above where we are right now, over and above our current deficits by the time we hit 2029. So this is coming at us very rapidly, but people just aren't taking it into account. And I think a really good intuitive way of understanding this is to look at the next slide, which is the $1 trillion stimulus versus rising benefit costs. People talk about the so-called Trump stimulus of spending $1 trillion on infrastructure over the period of the next 10 years. And that sounds like a lot of money, and people are talking about, can we possibly afford that, or things like that. Well, those are the blue bars, the infrastructure stimulus. The orange bars are, again, and this is from the Congressional Budget Office, their projections for the increase in benefit cost, not total benefit cost, just the increase from where we are today. And as you can see, they absolutely dwarf this so-called $1 trillion stimulus. The $1 trillion stimulus is almost a rounding error by the time you're getting 7, 8, 9 years out.
Sure. Now, Daniel, just to clarify, in the last 1 to 2 years, what are the added costs that Medicare has to account for when you're talking about an individual person having to cost Medicare more money in those last 2 years? What difference does it make with regards to the earlier years?
It's not uncommon to have the cost in the last year or two of life equal all previous medical expenses combined.
Because of what?
Dying's expensive. Regardless of how it's happening, the particulars, let's say it's cancer or something like that. And again, this is getting a little bit morbid. It can be congestive heart failure. There can be all kinds of conditions where in a relatively short period of time, in those last 12, 24 months, 6 months, 3 months, whatever the case may be, someone is so they're spending time in the hospital, they're spending time in a nursing home, they're getting a great deal more medication, they may be having some surgeries, they may be having chemotherapy, and all of a sudden they are spending vast sums of money compared to, let's say, what they were at age 62 or 65 or 67. And I guess that's going to vary very much by the person. But when we take that 1-2 combination, and again, this is as predictable as they might say death and taxes, when we look at how the baby boomers are aging, and we look at our best understanding right now of when people are likely to retire, what their expenses are likely to be, we have this vast wave of expenses. That's what we're seeing with those orange bars that's just coming straight at us. And if we look at Exhibit AD3, I have that in dollar terms, where net benefits are going from just over $2 trillion estimated for this fiscal year 2017, to almost $4 trillion a year by 2026.
Now, which states are more popular with the retirees?
Well, you'd be looking at places like Florida, the Southeast in general, Texas, of course, Arizona, different places like that.
And what are the proposed solutions? Obviously, the government is aware of some of these statistics, whether they choose to act on them or not. But there's got to be some kind of oversight and proposed solutions to what's going to happen.
They really don't have it. The government has a number of very long reports out there. I mean, if you're looking for an exciting afternoon, you can go spend a half a day reading 200 pages on their estimates for future Social Security costs, or the same for Medicare costs and so forth. They really don't have the solutions. First, anytime that you're looking at longer-term government projections, it may sound dreary, but it's really a course in miracles, because they make so many highly positive assumptions about economic growth rates, about increases in immigration, about having large numbers of young, fertile, highly productive immigrants coming here and immediately contributing large amounts of money, which then goes to pay for Social Security and Medicare for everyone else. There's just a long series of very positive projections they have, but they still have the money running out themselves. And they're not showing how to pay for that. And that's why I did a 3-volume research report, How the National Debt and Surging Benefits Will Transform Retirement Planning, just trying to put actual numbers on this, because we're getting so close and it's just so critically important. But what's also important to keep in mind is this is only one of our 3 arrows. If you come back and you look at that kind of yellow-orange 3 arrows again, the other issue that we have is the national debt. It's about $20 trillion right now. And what I took a look at in Exhibit AB3 is I showed what would happen if interest rates were returned to the long-term average, which, if we're looking at the United States 10-year Treasury, it's about 5% above where we are right now. And, of course, the math is pretty simple. $20 trillion in national debt. If the average interest payment you make goes up by 5%, that means you've increased your interest payments by $1 trillion a year. Now, as shown in that, it takes a while to phase in, because not all the government debt is short-term. It has short-term components, medium-term components, long-term components. But where things get really shocking is if we move to Exhibit AD3, which shows the numbers, or Exhibit AD18, which has it in graphic form on an inflation-adjusted basis. But looking at AD3, it's not just the problem that we have with net benefits going from $2 trillion a year in 2017 up to $3.8 trillion a year in 2026. We also have interest payments climbing from $378 billion up to a little less than $2 trillion. And you put those two together and you have it's like 2 exponential factors feeding off of each other. And you have this just astronomical explosion in the annual deficit and in the amount of the national debt.
Daniel, how can Trump propose to cut taxes if such an environment persists? And I don't understand why the Congress will try to block the infrastructure plans, which actually can produce a positive return on investment, whereas benefits are basically money sucked out of the public domain into, for the benefit of the retirees, sure, but there's really no ROI there. So what's going on the federal level? Do you think they're doing this on purpose? How is this going on?
Well, that is not included in these graphs. That's an extensive part of my research report, was modeling different possibilities there. The reason for it is, other than just to justify a tax cut, and hopefully it will work, is that the single most important thing that has to do with determining what benefits we will all be paid, whether it's Social Security or Medicare, is the rate of growth in the national economy. Okay? If you have a sufficiently robust rate of growth, if you can get back to the rate of growth, let's say, of the 1950s or the 1980s or something like that, then there is a tremendous amount more real resources, and that's what really matters, real goods and services that are available to support people past their working years, and everyone can have a higher standard of living. The problem is that if you take a very redistributive approach and you say, well, I'm just going to raise taxes until every aspect of Social Security and Medicare can be paid for, then you have the issue that's likely to reduce the economic growth rate. And the economic growth rate is the wealth engine that all these long-term projections are based upon: Social Security, Medicare, state pension plans. And if you knock that out, then you run into a much worse scenario. So let's compare a couple things here. One of them is, let's look at Exhibit AD18, which takes a look at inflation-adjusted cash flows over 30 years. Now, it doesn't say this so right there. This is all here on my website on danielammerman.com. I've got just some extensive analysis there. This is with a 2% real assumed national growth rate, which is kind of the average right now for long-term projections. I think the CBO is at 2.1%, Federal Reserve's at 1.8%. So this is not a really conservative assumption or anything. If we look at the blue line, that's taxes coming in. If we look at the red line, that's benefits going out. And you can tell just at a glance, when you compare benefits going out to taxes coming in, we've got a problem. I've got general governmental spending that's being held level as a percent of the economy. And then we have our rising interest payments if interest rates were to turn to something closer to market levels. Well, when we put those two together, we have the benefits line, which is what we fully expect unless they start slashing benefits, are going to be growing faster than taxes coming in. We have interest payments that are growing faster than taxes coming in. And we have that bright yellow line of the deficit just absolutely exploding upwards over time. In fact, it's passing general governmental spending in less than 10 years by the time we're at 2026, which is just a crazy place to be. But what is much worse than that is if you go to Exhibit GA18, which is the second to last one in that group that I sent to you. And in that one, you can see what happens if we don't have robustly positive growth. Well, if we have taxes just kind of hanging out flat with that blue line, and we have benefits jumping upwards with the red line, we have interest payments jumping upwards with the purple line, we have an extraordinary explosion in annual deficits where they are, in fact, passing general governmental spending by 2022, 2023. So that would mean that every single dollar of general governmental spending, be it the Defense Department, be it the Department of Education, be it spending on national parks, be it keeping the lights on at the White House, every single dollar would have to be borrowed within 5 or 6 years. That is just what is so absolutely critically important about growth rates and increasing the growth rates. If you don't get the increase in growth rate, you don't have anything. But the problem is, how much with those tax cuts, and who knows to what extent they're actually going to get passed, what are they really going to increase the national growth rate by? And that's where things become very difficult to sort out. But the biggest issue is there's not necessarily any good answers here other than taking a reality-based look at what's going on and making your own personal financial decisions, not off of fairy tales, but adjusting it to what we're actually seeing. Because the problem is, when that national debt, we already had a huge problem, and we have known this for decades. For people like me who've been looking at this, we have known for decades that the 2020s were going to be a real problem, okay, when it comes to paying for Social Security, Medicare, even more to of the 2030s. We always knew that was going to be the case. And then the financial crisis of 2008 hit, and our economic growth rate dropped, which means we have much less wealth available, and the national deficit doubled, so we have this huge source of competition for the government dollars that are, and the situation is so terribly much worse now than it used to be, but people just don't understand it. when the national debt was allowed to double in the space of 8 years approximately, that costs all of us dearly in terms of our future retirement security, because they're all part of the same thing.
I'd like to go over some solutions. In your analysis, by 2019, so that's like a year and a half from now, we're reaching an inflection point. And I spend about 6 months out of the year, either in Europe or in Asia, and 6 months out of the year in North America. And, wherever I go, I see streets bustling with people. Amazon is one of those the largest companies in the world. It's a consumer company. Apple, the same. It's almost hard to imagine that this house of cards is coming down. And so what I want to understand from you is, what will this inflection point that we're seeing on the charts that you created, what will that look like in 2019? What is the inflection point?
Well, the charts that I have the inflection points on are AD15, if we're looking at a 2% growth rate, and then we have this much more drastic GA15 if we had an actual 0% growth rate. And the way I'm defining it for these, and this is a very convenient way to compare otherwise complex models and just bring it down to a single visual something that we're seeing visually that's very easy to follow and understand between different alternatives. And I define insanity as being the place when the when the deficit borrowing exceeds total governmental spending. Yeah, for any nation that's reached that place historically before, there's no good endings. That is completely out of control. And I'm looking at the inflection point as being about halfway there. And that's the red in the charts. The inflection point is once you reach 50%. That's the yellow zone. And things could begin spinning out of control very quickly. Now,
Great. We're going to reach that inflection point by 2019?
If we had two things happen, one of that being, with that example there on Exhibit GA15, if we had a 0% real economic growth rate and we had interest rates climb up to their historic norms, which means a 5% increase in interest payments. And if you take that combination, let's look at them real quickly here. If you take the combination of the orange bars from the coming surge in benefit costs, which was our first graph that we were looking at, and you add to that an explosion upwards in borrowing costs if we were to have a return to market interest rates, and if we don't have surging growth to pay for it, then yes, we could get a place inside.
Sure. Daniel, I want to discuss some solutions here. What is the best suggestion for someone on how to increase his income starting today, immediately, so he can start to save for retirement? Where do you see opportunities for people right now within the U.S., outside the U.S.? I mean, what you're presenting is a very serious problem for retirees, but also for the working class, because they have to fund these by taxes. So where are the opportunities, Daniel?
This is an area that I've literally been working in decades, because it is just so difficult to do. I don't know that you can do this if you follow the usual norms when it comes to retirement planning. For instance, the usual thing that people expect is that if you invest your money, and as you get older, it's supposed to be really an interest-bearing investments, you will earn a positive rate of return that will compound wealth for you over time. But the issue that we're running into right now, and this is maybe a little bit of a technical phrase for some people, but for people who are well-read in finance, it's all around the globe right now, and that is negative real rates of return. We have literal negative interest rates in Japan and Europe, but in the United States, as a matter of policy, we have interest rates that do not keep up with the rate of inflation. So the longer we invest, the less money we have. And what that does is that entirely inverts the structure of retirement. where instead of having our savings worth more every year, they buy every less every year. And we need to look at doing some very different things with regard to that. And protecting against crisis is of crucial importance. I would also argue that it is very important to understand something that both governments and corporations do, which is asset liability management. What the government has been doing is it has been systematically redistributing wealth on an entirely intentional basis from the average person to Wall Street and corporations. Because what they're doing is they're taking these very low interest rates, they're borrowing at an artificially low rate, often below the rate of inflation. They're reinvesting that money in markets that are being held up by the Federal Reserve and by the government, and they're creating these just fantastic profits that are ultimately artificial and are based on basically taking the money from the little person. And there's different ways of looking at that. One of them is to get politically outraged, and I suppose that's appropriate. Another way of looking at it is saying, well, what's the information value there? What can I do differently so that I'm less of a victim and that I maybe have an ability to align my interests with the reality of what's going on and find a way of profiting from it?
And so what are those ways? Is there any profession, any occupation? Are you strictly talking about investing? Many people do not have more than 10 to 15,000 for retirement. That's obviously not enough at all. Where are the job opportunities, the second income opportunities for retirees or people approaching retirement, or where's the mega growth opportunities for millennials in your opinion?
I don't know any way of distilling that down to just a few sentences or 5 or 10 minutes or so forth. What I try to help people do is that I do have solid solutions. They take time to learn how to do them. I wish I could bring it down to a few paragraphs. But I think the starting point, regardless, is reality check. And I think maybe a good way to close is looking at what's happening with Puerto Rico. And I just wrote an article about that. Puerto Rico has a very real problem. They have, it's not technically bankruptcy, but it's a form of bankruptcy that they've entered into on $73 billion worth of government debt in Puerto Rico. And as it turns out, they also have $45 billion in unfunded retirement obligations. And if you can't make your payments on your $73 billion in debt, you can't make your payments on your $45 billion in retirement obligations. They also have a healthcare system that is in free fall at this point. It's just crashing. They can't even keep the power on. Medical professionals are leaving the island. They don't have the medicines they need. That's falling simultaneously. And the problem is, if you can't pay for your $73 billion in debt, and you can't pay for your $45 billion in unfunded retirement obligations, well, you can't pay for medical care either. So the way that I'm viewing this is, and as recently as 2004, this sounds obvious today, but as recently as 2014, nobody was seeing it. You still had general obligation bonds from the Commonwealth of Puerto Rico trading at 100 cents on the dollar. So what I strongly believe is that people take a reality perspective. That reality perspective is that all of this is holistic. The national debt, Social Security, Medicare, interest rates, they're all very tightly interrelated, and we just can't make good decisions about anything until we understand how intertwined everything is.
Daniel, look, we appreciate you coming on the Titans of Industry show. Where can listeners find more of your work?
At my website, danielammerman.com.
Perfect. Thank you very much for coming on the show.
Thanks so much for having me.